Most founders think that the most difficult part of a fundraising process is to raise the funds. In all reality, raising funds is relatively easy. What you do with the money after you raise the funds, that is the most difficult and the most dangerous phase of a business. Let me explain this in two different parts. Part 1, I'll tell you how the founders normally behave. Part 2, I'll tell you what the founders should actually be doing. When a startup raises its first round, everybody is happy around it. The employees are happy. The founders feel validated. The market starts noticing you. But the most tricky part comes in after the money comes and drops into your account. How you behave, how you use that fund wisely, that is the difference between winning and losing in a very, very tricky situation like this. The moment the money comes in, it is a choice between discipline versus distraction. There are two things that are likely to happen. One, the founders go gaga. They are all over the place. They are too happy over Cloud9. Now they want to spend this money. The founders start declaring unnecessary bonuses. They get into unnecessary partnerships, very high, expensive collaborations with big celebrities, big stars. They are not even relevant to the business. They start sponsoring big events, assuming that the market reach will be high, but the events may not even be relevant. They start burning a lot of cash just because they have the cash. These are total distractions and these are totally disastrous. On the other hand, the employees can stick to a plan. If you remember correctly, when you pitched to your investor, you put in a projection in an Excel sheet. The Excel sheet, the very Excel sheet that convinced the investors to put in their money. Try and stick to that projections. But it is very, very difficult. Let me also tell you that sticking in reality with the projection that we gave to our investors is very, very difficult. But if you are able to stick to it at least 70% of the projections, then we are in for success. 30% here and there is fine. New things come, new ideas change. All that is bound to happen. But stick to the projections as much as you can. Let me tell you the part 2 of how a business and the business founders should behave after raising the funds. The first thing that they have to do is to bring in a better structure, a post-funding structure to their business. For example, if you have two founders in your business, two co-founders, founder 1 should decide that he or she will take care of all the operations. They'll continue to do what they are already doing. They'll continue to scale the business better. They'll continue to work with the investor, create a good rapport with them. The investor management, investor handling, all that is done by this first founder. So what does the other founder do? This is the most important part. The other founder goes for another round of investment. His only focus is to bring in the next round of investment within 6 months of getting the first round of investment. But sir, why? This money I have will last for at least 2 years. It will last for 2 years. And what after 2 years? When the business is going up is when you will be able to raise funds. You raised it now because your business is doing well. That is exactly when you should use the opportunity and keep raising funds. Keep increasing the value. The valuation increase is done by the founder 1. With that raise in valuation, keep raising funds. As you raise funds, your confidence grows. Investors also want to invest in a company that was recently invested by somebody else. They trust another fellow investor more than they do you. So this is how you should structure and keep going for the next round of funding. Raising money doesn't build a startup automatically. What you do with that money after raising, that determines the success of the startup. Funding is not a finish line in your startup. It is actually the moment the discipline becomes even more important than ever.